Welcome to Catalyst. I'm Madison Mills. 30 minutes into the U.S. trading day, let's get you the three market catalysts we're watching this hour. First up, we'll bring you full market analysis ahead as the S&P 500 enters record territory. What are the catalysts to hit fresh highs? We're going to discuss. Plus, we push ahead to this week's inflation data and break down the impact of tariffs and what it all means for both investors and the Fed. And we'll bring you everything we know about Tesla's robotaxi event this week. Can it help the stock amid the Trump-Musk feud? We're going to discuss that and much more ahead on Catalysts. Half an hour into the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages here, you've got the Dow under a bit of pressure, but you got your S&P 500 maintaining above that key 6,000 level, up just above the flat line. Your tech-heavy NASDAQ up about 0.2%. Let's flip the board over to the bond market, which has been responding primarily to that economic data that we've been getting. And you got your 10-year down about a basis point. We've got a key auction this week, $39 billion worth of 10-year notes up for sale. You've also got a 30-year auction later this week as well, which will give us key insight into what investor demand looks like for the longer end of the curve amid all of those deficit concerns. Finally here, let's take a look at Bitcoin. It is moving to the upside, a bit of a risk on move there. You've got it up over 1.3%. Well, I want to bring in my contributor for the hour. We've got Mark Lehman. He is Citizens JMP Securities CEO and also the president of California Citizens as well. Mark is going to bring us great insights throughout the hour, so appreciate you being here and coming to us from California as we were discussing. I just want to get a sense to start on what you're hearing from investors these days amid the continued tariff policy uncertainty.
Yeah, and thank you for having me. It's been a couple months, obviously, when the tariff noise really picked up. Yeah. The word I heard the last week, which I have not heard in 2 months, is normal. Mm-hmm. And whether it's the stock market acting a little more normal, the bond market acting a little more normal, our clients, frankly, acting a little more normal is new. And it shows with the way the markets have sort of calmed down a little bit. And you see that in the VIX. We've also seen a resurrection of IPOs. They haven't been the flood that we saw in 20 or 21. But there's more, and that's really an important part, an important catalyst, I think, for the markets for the next leg. Yeah, certainly. And it makes me wonder, too, what you're hearing in terms of the justification for the normal, given that we still don't have the trade deals yet. Yeah, I think the unknown is what the market hates. And I think with the tariffs, we've had a lot of unknown. I think the draconian noise, and let's be clear, we could hear more of that at any moment, and that's possible. But I think the worst possible outcome, we think, is in the rearview mirror. And I think there will be some resurrection of trade talks, which obviously the market likes. And also, the market just need to know where the interest rates were going to fall, how far they were going to fall or how far they were going to rise. This kind of level that it's at, this kind of normal yield curve, seems to be coming into the front mirror as opposed to the rearview mirror, and the market likes that. So we know what we have to deal with. That's interesting. So then do you think if the market kind of likes where the yield curve is at right now, do you think there's a preference for the Fed to continue to stay on hold? Yeah, I mean, I think it's a good question. I think the market is benefiting, obviously, from some of the anticipation of the trade talks and the anticipation of the tariffs that people got ahead of. Now there's this period where there's probably some diminution in terms of growth and some diminution in terms of demand. And we're seeing that in some of the data for tourism, and we're seeing that for some of the people who are predicting a little bit of a slowdown. And I think the Fed is taking that in stride. I think the Fed is doing a pretty good job. And I always say you don't get credit for what you don't do. And what the Fed has not done, I think they should get credit for. What they have to take advantage of is what is happening. And I think by the end of the year, we'll see some of that. So you think the Fed should not capitulate to what the White House is pushing for when it comes to rate cuts off the back of that is not their mandate. Yeah. Their mandate is to fight inflation. I think they're doing a good job. You think they're doing a good job? All right, well, that's going to be interesting to see as we get that CPI data later this week here. I also want to hear a little bit more from you just in terms of what you're hearing about that deal making that you had mentioned. It was interesting. We had a chart from Torsten Slok this morning, obviously backward looking, but it did show a decline in M&A deals. Even though we keep hearing about these M&A deals popping up, what is the status of deal making? Yeah, I mean, it's correct. I mean, we basically had a period when the tariff noise got the loudest where people just shut down. And that obviously is across the platform. That's across IPOs, that's across M&A, that's across capital formation. And like I said, I think normal is more the norm. So I think there were some pauses, and I think there were some people who just said, until we figure out what this is, we're not going to do transactions. And I think that's starting to slow down. You're right. I have been hearing for 2 years about this enormous glut of backlog and this pipeline of M&A, as well as this IPO pipeline. And that's correct. It's been pushed out. But I think that push out, like I said, was a month or two ago, and now those are starting to form. And we're seeing some of that at Citizens here real time. So I'd expect a very good second half for those markets, particularly by the end of the year, when, again, all this noise should dissipate, and that will be really good for the market.
What is the biggest thing that you are hearing from clients right now that you think is not being reflected in the national conversation around markets? What's something that might be surprising?
It's a really good question. I think a couple things. One is, I think there's a lot of noise about what the next big thing is, and how much monetization we could have with AI, and when does that happen. I think that's a really important catalyst. I also think there's this resurrection in the IPO market that, again, will not be the 21 levels that we had before. That I think is really important catalyst, because people do want new ideas. The third thing I'd say is the Magnificent Seven have driven so much of the market the last few years, and what is the play for the Mag 7? And as this broadens out, that's healthy. And I think the last thing that is not popular, which is that California and San Francisco in particular are about to fall into the ocean, and nothing's happening out there. Well, it moved from the 5th to the 4th biggest economy in the world while we were sleeping, and 200,000 people are there this week for Snowflake's developer conference. So I think that tells you that catalyst, which AI dovetails back to the AI conversation I have, a lot of that's happening in California, will be really important for the economy and really important for the country, because winning that AI race is everything.
Yeah, and it's certainly been a huge question for investors. Is that AI ROI going to come in? So appreciate that context, really helpful for our audience. Thank you so much. Appreciate it. Market's going to stick with us for the hour. All your markets action ahead here on Yahoo Finance. Stick around. You're watching Catalysts.
With the big monthly CPI print on Wednesdays, investors are going to be laser focused on any clues as to tariff-related inflation. But stepping back, what is the biggest driver of moves in stocks and bonds? Jobs, CPI, or the Fed itself? Today, we're going to check the scoreboard. I'm Blikre, host of Stocks in Translation. We're going to show two charts with each of the three big market movers going back to the start of the October 22 bull market. And we start with the S&P 500, America's benchmark stock index. Blue here shows the cumulative market reaction to non-farms payroll jobs data, the big monthly numbers. In green, we have the reaction to consumer price index reports, and in orange is the running total for Fed decision days. Finally, in white is the S&P 500 itself. Now, the inflation and jobs report, they come monthly, and the Fed meetings happen about every 6 weeks or so this makes their lines all look like stair steps. Since October of 22, green CPI days dominate with a 16 percentage point market gain. That is over 6 times the jobs day boost and more than wiping out Fed day drags, which clocks in at a negative 3%, by the way. But zoom in since Trump's election last November, things shift as quickly as those tariff announcements themselves. Jobs data turned from boost to burden. The blue line is down 5 percentage points from there. CPI went up, then down, but net it is flat, offering almost no relief since November and introducing a lot of volatility, by the way. And orange Fed days, they are still dragging stocks lower. On net, 2 recent reports drove home some of this new bearish mood. The April 5th jobs report, the huge blue drop towards the right, it showed modest job gains, but stocks sold off hard. They were piling onto those post-election weakness vibes. Also, the April 10th inflation report, which caused a big green drop right at the top right, a negative headline print for inflation was not enough. Stocks slipped further, and instead of cheering the cooling inflation, investors feared slowing growth, worrying about the dreaded R word. That would be recession. Now, let's take a look at how the bond market reacted to these very same reports with the 10-year yield. Why watch it? Trump 2.0 cares more about stocks than bonds this time, and yields signal whether his growth plans get traction or trouble. Rising yields mean higher borrowing costs and maybe more Fed hikes. Modestly lower yields are okay for risk markets, but if they drop too much, that is actually a sign that there are doubts about the reflation trade and that the economy is in trouble. So looking back to the chart, we have orange Fed days. They are the big bond movers here, pushing the 10-year in white down 98 basis points overall. But notice that the blue job jobs data since November, adding 26 basis points, signaling new worries that a tight labor market means sticky inflation and more Fed action. In fact, on Friday, just a few days ago, the monthly jobs numbers drove the 10-year yield up 10 basis points, the most since that April 8th market plunge. All in all, jobs set the tone for yields, inflation steers stocks, but the Fed makes the rules. So mark your calendar. CPI prints Wednesday at 8:30 a.m. Eastern. Another big stair step might be coming on some of those green stairs. Tune in to more Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Jared, thank you so much. It's now time for some of today's trending tickers. We are watching Meta, Robinhood, and AppLovin, and Circle. First up, Meta in talks to make a multi-billion-dollar investment into artificial intelligence startup Scale AI. That's according to a report from Bloomberg. Now, the financing could exceed $10 billion, which would make it one of the largest private company funding events of all time. Mark is still here with me to discuss. Mark, what do you make of this deal from Meta? Why does it make sense for them?
Well, it's AI all the time. And I think Meta's certainly become one of the beneficiaries of that, of the publicly traded companies who have taken advantage of what they have in their core base and their uniqueness of their data. And I think my analyst Andrew Boone has been saying that for a very long time. We've had this stick with the winners theme at Citizen for a while, and I think Meta's certainly a winner there, and they want to promote and accelerate what they're already doing. And I think it's a great idea for them, and frankly, it's a modest investment for them.
Right.
It's really modest when you think about that,
right,
at a big scale potential.
Yeah, I think that context is really important too, because it might be a big deal when it comes to the private company side, but for Meta, it's not necessarily a ton of cash. All right, well, next up, let's talk about Robinhood and AppLovin failing to gain inclusion into the S&P 500. S&P Dow Jones indices making no changes to the S&P 500 in its quarterly rebalancing. Before the rebalancing, a number of analysts had named Robinhood and AppLovin as contenders to join the index. Both stocks getting hit off the back of that news. Robinhood down nearly 7%, AppLovin down almost 6%. Were you surprised by this at all, Mark?
You know, playing the add subtract game is a hard one. It's been going on for my 30 years on Wall Street. I was a little surprised. I think it's an eventuality, frankly, with Robinhood.
Yeah.
And Devin Ryan, who you know well, our analyst, thinks the same. We also think Robinhood is really one of the prime beneficiaries over the next decade about what they're creating, something scalable, something not really replicable and unique, and a great brand. So we're very bullish on Robinhood. Playing the ad game is tough. Sometimes it works really wonderfully, and today it's not so much, but I think it's an eventuality.
It's just a reminder, too, to folks about the importance of these rebalancing decisions and the degree to which they weigh on the S&P.
It really is, and it's a big testament to the right companies that they want to add. They take this very seriously, as they should, and I think it's really important. You look at the add and subtracts over time, and not only the indexes, look at what they do with the Dow over time. And think about what was in the Dow 10, 15, 20 years ago. And, you know, adding Salesforce when they did, a 25-year-old, they added it, I think it's 5-6 years ago. But when they added that, think about what that was a testament to what Mark Benioff's built, and it's a 25-year-old company.
Right.
So I think those kind of statements are quite important. S&P is obviously a much bigger index, and they take this real seriously, as they should. As they should,
absolutely. Well, finally here, let's talk about Circle continuing to climb after its strong NYSE debut. The stablecoin issuer soaring 168% on Thursday, raising more than $1 billion in its IPO, and you can see those climbing shares continuing here, up nearly another 16%. Is this just going to keep happening every day with Circle?
Probably not. I've seen this movie before in 2000. I by no means am saying this is analogous to 2000 with some of the internet stocks that took this kind of move higher. There's a scarcity value. There are very few IPOs. We just talked about that. There'll be more. We launched on eToro today, which went public about a month ago. That's similarly doing well, not quite as well as that. But there's scarcity value, and people want to play this market, and there's very few ways to play that. And I think they're benefiting from that. And there's not a lot of float.
Right.
That's what happens.
Right, exactly. Yeah, great overview, Mark. Thank you. Circle is the latest IPO to spark optimism on Wall Street, soaring in its NYSE debut on Thursday. Mark, let's continue to discuss the IPO market, because I know that there is so much hopium about this kind of release of deal making. What is it going to take for that to really start to happen?
Well, we're seeing some of it, right? We need stocks to work. And the IPO names that have gone public in 2025 have outperformed the stock market. That's the first thing. The second thing is I think they need to broaden out. And a lot of people think of the IPO market as the tech market. It's not just the tech market.
Yeah.
The insurance market, which we've been thankful at Citizens to be part of another deal launched on the IPO, is on the IPO roadshow this week. And so there's going to be more of that. And I think there's going to be a widening of the marketplace, but deals have to work. Like I said, I've been doing this a while. You rarely hear the buyers of those IPOs say, we want more. Usually they're like, slow it down. They're saying they want more. Like I said in the last segment, I think that people who have played the Magnificent Seven have done really, really well the last 5 years, particularly the last few years. That's probably not going to be the anthem for the next 5 years. And this market's going to widen out, and if it widens out, they need new names. And some of the benefit of that will come to the IPO window. And I think it will widen out. We're seeing that at Citizens.
But even that is a fascinating point. The idea that you're basically saying we need more names added to the S&P because there's not really a second best choice to the Mag 7. We need new meat to get that second best choice?
Yes. I mean, the last few years, you had to get the Mag 7 right, and some of them within the Mag 7. Right? If you played Meta, if you were a weighting much higher than the S&P in Meta, you won. Same thing with NVIDIA. Same thing if you underweighted some of the names that really weren't participants. That was the win. That was how you won the last 5 years. I don't think that's the case the next few years. The market will have to widen out. You're going to have all these new cyber names, all these new AI names, all these new crypto names that are going to be a bigger part of the S&P and the bigger part of the weighting, and getting those right. And one thing Warren Buffett, who retired, as you know, recently, said very eloquently, which is he didn't get them all right. You know, if you look at the outperformance of what he got right, it was a couple of 3-5 names. And the course, he said it very modestly. He said, over the course of my years, I got a lot wrong, but I got a few right. And of course, that's not true. He got a few right. But the ones he got right, he got really, really right. And that's really what the markets, as a portfolio manager, as somebody who invests, you do not have to get them all right. You have to cap your losers, but you got to pick a few names and get them right and outperform.
I love that framework because it also makes investing feel a little bit more approachable for folks that you don't have to be, this incredible genius necessarily.
Absolutely.
You just got to get a few right. I do want to get your take on M&A activity more broadly here. We have Qualcomm buying Alpha Wave, the Qualcomm stock continuing to move to the upside, I believe, off the back of that deal, the street being happy with it. To what extent do you think that is a signal about increased deal making?
The public companies making big acquisitions is a big deal. Last week we had Blueprint, a biotech, being taken out for a 30% premium. I think it's an important catalyst for the markets. I think this normalcy, which we talked about, again, I hadn't heard the word normal for a very long time, is what the market wants. I think that will be a catalyst for M&A. I do think the back half will benefit from this normalization of the marketplace. And I think it's really important that the public companies see that kind of value, even at these premiums.
Yeah.
They see that as their catalyst for growth. And I think that's an important statement by them. And that's good for the overall market.
And you're in California. You're talking about AI all the time. To what extent are you hearing from folks that there still is concern about DeepSeek? Is that still coming up in conversations?
Yeah, it definitely does. I think less so. I think
I wonder why. Why have we moved past
because
DeepSeek risk?
There's an old Mark Twain line: 90% of the things I worry about never happen. And I think that's part of it. I don't think it's slowed down in the investment dollars. And there's just the amount of money that is being raised in the private side has not slowed down. And I think that's a really important statement that people still see that. We've also started to see some of the people who are a little long and they went overweighted in private.
Yeah.
We've seen that with some of the universities and endowments that really want to get more liquid.
Yeah.
And there's a market for that too. And you're going to see that in the next couple quarters and years. I think people who feel like their exposure is too high, there's people who price that properly are going to make a lot of money when they buy those. And that's happening too.
That's a helpful, I'm going to keep that in mind for upcoming stories. So
Yeah.
thank you. I appreciate that. Thank you for the context, Mark. And you're going to, of course, stick with us for the rest of the hour. Let's move to Apple. Apple's Worldwide Developers Conference kicking off today in Cupertino, California. Yahoo Finance's tech editor Dan Halley is live on the ground ahead of the event. Dan, great to speak with you. Talk to me about what you're expecting to hear today.
Yeah, Maddie, I'm here in Cupertino, and basically what we're looking for is for Apple to give us any sense of where they're moving as far as AI goes. Now, we've already seen some reports. Bloomberg's Mark Gurman had said that we're going to get new looks for the iOS interface, the iPad interface, the Mac OS interface, basically some design changes that should get people excited. But I think the broader question is going to be, is Apple competing in the AI space the way it should be alongside competitors like Microsoft and Google? And so far, it doesn't seem as though that's on in for the offering. We're going to get some minor AI updates according to those reports, but nothing that's going to really blow people away. Google just had their I/O conference. They showed off a slew of new AI technologies. They announced their AI mode, which is basically a ChatGPT competitor for the standard Google search for US users. Microsoft had its developer conference Build the day before I/O. They showed off a slew of new AI improvements for developers. I think what Apple's going to have to do is show that it's there for developers, that they should be building on Apple's platforms with AI in mind, and then that may help Apple kind of make a snowball effect when it comes to building up on its AI capabilities. But overall, I think for this event, we're not expecting that much when it comes to AI, a lot more when it comes to the usual stuff that we were used to at prior WWDC events, the interface changes, the updates to certain apps and widgets, things along those lines. I think it's going to be more that and less the mind-blowing AI that we kind of were anticipating last year.
Yeah, and Dan, I am curious in our final minute together too, if you think that there's anything under the hood that Apple may be able to report to investors that would get them a little bit more excited about their AI capabilities.
Yeah, I think one of the plans, according to that Bloomberg report, is for Apple to start opening up their own AI language models to developers. And so that could be something that gets Wall Street excited. It's, the way I kind of think about it is not to the scale, but kind of akin to the App Store. When that opened up, it opened up a whole new world of apps and changed the economy. I'm not saying it's going to be like that. I'm just trying to lay out the power that developers could have. And so if they do open up some of their AI capabilities and they happen to be good enough, then we might be able to see some developers building some really interesting apps. And then that could get people more excited as time goes. Yeah, Apple's an interesting company. They don't have the business side that Microsoft and Google have, the enterprise offerings at scale that they necessarily have. Apple is a consumer company when it comes down to it. So their offerings have to be consumer based. And so if app developers can put those out there, then that would basically take care of the heavy lifting for Apple, I think. But they have to show that they can get those developers excited. And this is a developer conference, so hopefully we see that.
Hopefully we do, Dan. I know you'll be bringing us those headlines as we get them. Thank you so much. We got all your markets action ahead here at Yahoo Finance. Stick around if you're watching Catalyst. Stocks are mixed today. The S&P 500 holding above the 6,000 level. The benchmark index has bounced over 20% from its April lows. Our next guest calling for caution amid the rally, citing recent weakness in economic data. Joining us now, David Kelly. He is JP Morgan Asset Management's Chief Global Strategist and Head of the Global Market Insights Strategy Team. David, it's wonderful to speak with you. Thank you for making the time this morning. I know in your latest, you talk about how you see an economy that is slowing and causing trouble in the foundations of the market and the macro environment. What is that slowing looking like to you?
Well, yeah, we're seeing a fairly broad slowdown in economic activity, and there's a lot of noise in the data. So this is hard to, it's hard to see sometimes. And I think also when you look at the market having done very well over the last 2 months, you might think that there isn't a slowdown going on, but there is. You can see that in the labor market data, that 95,000 downward revision to payroll employment growth for the last 2 months means that average payroll growth has just been 124,000 per month in the first 5 months of this year. That's slowing. We can see also other data like a falling labor force participation rate, a lot of layoff announcements. All that suggests that the labor market's slowing. And then when it gets to the real economy, I mean, we're looking at things like declining tourist activity. We can see that in data on TSA checkpoints, immigrant or non-immigrant visas. We can see the signs in the auto industry of people buying cars before the tariffs. That's going to slow down. So you can see this overall slowdown going on. Meanwhile, I don't expect the Fed to cut rates anytime soon. And that combination really means people ought to be a little bit cautious here because the markets, the correction is over. The market's up year to date, but there really are more problems than we had at the start of the year.
So what do you make of the fact that the party is continuing? To your point, you've got the equity party upstairs while the basement is leaky. What is that a sign of if it's not economic strength? Is it big tech's resilience?
Well, I think it's a little bit of it's investor confusion, and some of it may simply be plenty of money in the hands of rich investors. I mean, we've had a lot of money sitting on the sidelines for years. That money gets pumped into markets. We've got a very unequal income distribution. So, there's often a disconnect between the economy and markets. But it's also a little bit of a waiting game here. We haven't seen the real effects of these tariffs and pushing up in inflation, slowing growth yet. So I think perhaps people think that, well, if the market's beginning to go up, I can safely get back in. I can invest right now because that's telling me everything's fine with the economy. And actually, everything isn't fine with the U.S. economy.
So what would a healthy market move look like? I mean, today, a big kind of question that's been coming up is that we're about 3% away from all-time highs. What's it going to take for us to get there? But do you think it would be healthy for us to hit another all-time high in this environment?
Not necessarily. And I think actually that's part of the Fed's thinking also is, regardless of what any Fed rate cut would do to inflation, if the Fed were to cut rates aggressively, that might push valuations even higher in the equity market. Remember, we are at very high valuation levels on US equities. So I think from an investor perspective, the healthy thing to do is look at those valuations. There are plenty of things that aren't overvalued. Value stocks aren't overvalued. International stocks aren't overvalued. I think most fixed income is pretty much fairly valued. So there are ways of spreading money around in a diversified way. But I think it would be unhealthy if the market were just to soar straight to new highs, even as the economic foundations continue to, worsen somewhat here.
And since you mentioned international, something I've heard a lot from sources is the idea of looking at countries that are getting stimulus and investing in those countries. But they've also said that the international trade may be sustained on an idea of weaker countries becoming less weak via stimulus. And that doesn't sound that bullish to me. What do you make of that idea?
Well, that's true, and we may need a stronger idea to get American investors really excited about investing internationally. But I think you start with valuations. The fact that that even after a good few months, first few months of the year, U.S. PE ratios are about 50% higher for the ACWI ex-US. So international equities are cheaper. And then also, if you look at Europe, I think the fact that the Germans are now spending money, I think that Europe realizes that it is it hasn't spent enough money. It's got its fiscal policy is too tight, but also they face a real security threat from the East. Because of Russia. And I think they are waking up to that. I think they're quite aware of that. And so I think they will spend more in defense, and that could help the European economy rebound. In the US, we've got reckless consumers. They don't have them in Europe, and that's their problem. But I think European governments could spend more aggressively to try to build up their defense capabilities, and that could help a lot of European companies.
And I know domestically you mentioned value stocks. What is the defining factor of a strong value stock in this environment?
Well, I think I think you have to have cash flows which aren't as vulnerable to a cyclical slowdown. So you don't want to think too much about very strong capital spending or luxury goods or very discretionary purchases. So I think that's part of it. And then you also want just more reasonable valuations. It should be more about cash that's being earned in the here and now rather than in the hereafter. But it's pretty easy to figure what's a non-value stock here. I think that's really the point. It's not so much, there are a lot of opportunities out there. You just have to avoid buying stuff that you know in your heart is just silly. And if you can do that, you'll do fine.
I think that's a great overview, David. I do want to mention some headlines we're getting crossing the wire here. The Wall Street Journal citing people familiar with the matter on U.S. negotiations, saying Trump has said let the negotiators weigh lifting export controls. He also says he's going to let Besant levy tech sale controls in these China talks. And again, letting negotiators weigh lifting export controls more broadly. How big of a catalyst do you think that is if we do see a lifting of those export controls?
Well, I think it's helpful. I do think the high watermark for tariffs in the United States was really, in early April. And I think what I hope everybody's understanding here is that there is an integration in the global economy that you shouldn't just throw aside. This is not the 1930s or the 1830s. It is just too difficult to untangle the relationships among all of these countries at the drop of a hat. And so I hope that what this means is we're going to be all more reasonable on both sides or on all sides to try to maintain trade, we can have views as to how to make the U.S. economy more productive and more dynamic over time, and that could lead to a better trade position. But you don't want to do it overnight. You don't want to burn the existing trade boats before you build new ones. And I think that to the extent that negotiations are based on common sense and reason in both sides, that's all a good thing. And talking itself is a good thing.
Where do you think the tariff policy's impact in terms of inflation and the macro picture is going to net out? What do you think this is going to look like 6 months from now?
I think we will see higher inflation. Right now we're at a consumption deflation rate of 2.1% year over year, which is actually very close to the Fed's 2% target. But I think that by the end of the year, because of the tariffs, we'll be at about 3 to 3.5% of the consumption deflator. So we expect that we'll have this universal tariff of 10% will stay in place, probably 30% tariffs on China, something else, in different sectors. But overall, we'll add to inflation in the short run. And I think that inflation will be sustained to some extent by fiscal stimulus in the bill that's going through Congress. But by the end of next year, I think we'll be right back down to 2%. Tariffs are, inflation staggery rather than stagflationary. They initially give you inflation and then they just give you stagnation. They slow economic growth on both sides, and that slow economic growth will drag that inflation rate back down again. So I think it's a short-term issue with inflation, but the longer-term issue is just, does this actually make the American economy more dynamic or productive? And I'm afraid I don't think the tariffs do.
So it sounds like you don't see a risk of the Fed being too late to cut.
No, I think the real problem the Federal Reserve faces is interest rates aren't alarmingly high. I mean, a 4.25%, 4.5% on a short-term interest rates is on the federal funds rate isn't really too high. But the real issue is if you've got immigration policy which is limiting labor supply, and of course we need to do something to make to try to normalize the immigration situation. But if you discourage immigration altogether, if you discourage foreign investment, if you discourage international trade. If you do these things, then you will tend to both slow the economy down and push up inflation. And what the Fed is really saying is, look, we're going to wait until you can convince us that policies coming from the other side of Washington aren't going to push inflation up. And when we're convinced of that, then we can talk about beginning to lower interest rates. But right now, we need more clarity on fiscal policy, and we need to make sure that the policies in Washington, on the other side of Washington, don't actually add to inflation. I mean, and they don't want to be political. But I think they're just going to wait and see until they've got more clarity that we're not actually adding to inflation on one side of Washington while we're doing monetary ease on the other side.
And in our final minute, David, since you mentioned immigration, I want to get your take on the labor market. I've heard you say fascinating things before when we get layoff headlines that maybe, companies are trying to prevent people from asking for bonuses, for example. What would you say is your read on the news that we've been getting in over the past couple of weeks on increased layoffs at companies? Is that a signal of something more sinister under the hood, or is it regular for you?
No, I think it is a little bit more sinister. I mean, if you look at the Challenger Great Christmas, compiling of layoff announcements, they've been at very elevated levels for the last few months, and we're 47% up year over year in the month of May. So there's something real there. I do think it discourages workers for asking for big pay increases, and all things being, given the advent of tariffs, I don't think pay increases are excessive. But I think these layoff announcements are genuine. I mean, I think that companies don't want to do layoffs, but I think companies are frozen by the uncertainty caused by they don't know what the tariff story is. They don't know what the cyclical economic story is. They don't know what the tax story is. And the problem is, therefore, they all want to wait and see. And, one of the things I think is so important to think about is that every day in American businesses make about 3 times as many hiring decisions as they make about firing decisions. A lot of people leave a job or quit, but you need to have a positive, optimistic, clear outlook from corporations so they actually feel comfortable making those hiring decisions. And I'm afraid that all this policy uncertainty is just making them hesitate to do that. Now, it also will tend to hold down wage inflation to some extent, so I'm not worried about wage inflation. In the long run, I'm worried about growth, not inflation in the U.S. economy.
David, a great overview. Thank you so much for making time for us this morning. Appreciate it.
Sure. Anytime.
We're going to have all your markets action ahead. Stick around. You're watching Catalysts. Tesla planning to roll out its hotly anticipated robotaxi this week. Here with what you need to know, we've got our senior autos reporter, Pras Subramanian. Pras, what can people expect?
Well, this is a huge week for the company, right? This is the final, they're beginning their unsupervised testing of robotaxis, meaning there's going to be no driver sitting in the driver's seat. There's going to be a totally empty car. About 10 to 20 cars are still to start off with in Austin, according to Musk and the company. You'll likely use a Tesla app to summon these vehicles, as they've shown before with different mock-ups. Perhaps Model Ys at first, maybe some Model 3s, we'll see what vehicles they end up using. But interestingly enough, the safety. There'll be human teleoperators that will be kind of monitoring things, and we'll have to jump in case a car is stuck somewhere or something happens to that effect, where they can actually have a solution to a problem relatively quickly. So this is a big deal for them. We've seen a lot of the bullish analysts talk about this is the next step for unlocking the key $1 trillion in value with autonomous and physical AI and things like that. So big week for them, but a lot going on in Tesla world with Musk and Trump and all that stuff. That's also happening in the background. So I think a lot of investors will want to focus on this, and hopefully that goes well. But the 12th is the date, this tentative date, but you never know with Tesla. You never know if they might push that back, so we'll see.
Yeah, talk to me about the sort of totality of catalysts impacting Tesla investors right now. Like, can this event outweigh any of those negative headlines about the feud between Musk and the president?
Yeah, I think if Tesla's able to sort of cleave itself from Musk and show that we are not just a car maker, but we're also a technology provider, and we're going to advance in the space. And we were talking earlier about Waymo. Mm-hmm. They're by far and away the leaders in space right now. Like 250,000 trips a week, autonomous vehicles already doing their thing in Austin and LA and places like that. So they had a lot of catching up to do. But if they can do that, maybe they can actually just change the story a little bit, and maybe Musk will be more focused on that too.
And Mark, let's bring you into the conversation on that. Talk to me about what you're seeing when it comes to Waymo sort of owning the space ahead of Tesla.
Yeah, I mean, you're absolutely right. In San Francisco, where I live, Waymo's got a bigger share than Lyft, coming out of nowhere. At all hours, you see that on the street. Some of the questions you had about some of the driverless, when humans need interaction, that happens. But I would say on the whole, it is as normal as anything for people to take a Waymo, and it will be the same thing for Tesla. They are behind. You talk about that $1 trillion valuation, the thoughts on Waymo, which is in full operation, it's worth $45 billion right now. We'll see if that's true or not. But I will tell you, from as a rider and somebody who uses it, it is going to be as seamless as anything you do. It's safer, it's predictable, it's the ride you want. Frankly, the only complaint I have is it follows the traffic rules too. And so going 30 miles an hour when I want to go 40 ain't going to happen.
You want a yellow cab experience
exactly.
in the Waymo. That's interesting. Go ahead.
I used the Waymo in LA a few weeks ago, about a month ago, and it was perfect. I mean, it comes right up to you, has your initials on the little screen there. Walk right in, app, you're signed in, play whatever music you want. It's like all fully integrated, change the climate controls. It's like super easy. There's no driver there to kind of interact with. I think some people like, and then you get there safely. It's actually been a very good service. Is
there any, and we've talked about this before, but just for the audience, what is the price differential?
At the time, it was around, we'd say around the same as Uber, right?
Yeah, it's par. It's on par.
Yeah, but the joke is that there's no tip, right?
Yeah.
So,
That's true. That's true.
Maybe AI will say, hey, you said thank you, but where's my money? Where's my cash?
Right, exactly. You got to be nice to your robots.
I got a tip request from a self-checkout this week, so I don't know if that kind of tells you the same thing.
Tipping culture, something we can cover on our wealth show coming up, guys. Thank you so much, Pras. Thank you. Appreciate it. Coming up, what to expect from this week's inflation print. We'll get you that info next. The May Consumer Price Index is set to be released on Wednesday. Core year-over-year inflation expected to come in at 2.9%, and core prices expected to tick up 0.3% higher for the month. Investors expecting the Fed to hold rates steady in the June meeting as inflation remains stubbornly above its 2% target. For more, I want to bring in John Lear. He is Morning Consult's chief economist on what to expect from this week's data. Great to have you on here, John. Talk to me about what you're anticipating ahead of that key CPI print this week.
Yeah, thanks for having me. Well, I think, as you mentioned, I expect to see inflation remain stubbornly high. I still don't think we're going to fully see the impact of tariffs on inflation. I imagine that will be spread out over the course of the full year, with some of it actually backloaded towards the end of the year as businesses increasingly face pressures to pass on elevated costs. But I think the real question from this particular report is going to be, how concentrated are those tariff-induced cost increases? my expectation is it will remain fairly muted through the month of May.
So when do we finally see it? I keep feeling like sources are telling me, oh, we can ignore this data, we can ignore this data, we don't have the tariffs in place yet. When can I finally say, okay, guys, we can't ignore it anymore?
We see something, I think, pretty different relative to the consensus. We run a quarterly survey with the Federal Reserve Bank of Boston, and it showed that small businesses, at least, expect to spend roughly 2 years passing on the full cost of tariffs to their customers. And so my expectation is actually that we will see sort of a steady drip of price increases rather than this one-off surge, due likely to the sort of competitive dynamics in the U.S. economy. It doesn't benefit any company to be the first one out to increase costs when in fact the tariff policy might change underneath you. And so we really need to see more stable policy announcements, and that I think will lead to a pretty gradual but protracted period of cost increases.
Yeah, and similarly, what are you hearing from those small businesses about the employment picture going forward?
Our read is that employment actually has not pulled back. I think what we see is that the rate of hiring has slowed, but it's been slowing on a trajectory sort of consistent with where we were prior to the tariff. So it doesn't look to us like tariff-induced, we've seen tariff-induced hiring pullback or hiring slowdown. And that's really counter, again, to the narrative that existed, let's say, a few months ago, where everyone expected tariff uncertainty to drive and a pullback in investment, and then even potentially elevated layoffs. We simply don't see that. I think small businesses and consumers out there as well, what they're seeing is that the world remains fairly uncertain. It still is in the financial interest of companies to keep workers on their payrolls when there's so much demand to benefit from.
And Mark is still here with me in the studio as my contributor for the hour. We're just getting headlines crossing. Barclays is cutting more than 200 investment bank jobs to pare costs. We were talking earlier about the slew of companies coming forward with cost-cutting measures via labor. How are you thinking about that as a risk to the economy and markets?
Yeah, I think everybody's looking at their labor force and seeing what's the right sizing. They're also seeing the impact of AI, which will definitely have a factor in terms of certain jobs that will absolutely be cut because of AI.
Yeah.
So that efficiency will increase at the same time that people have fears about the growth of the economy. So I do think that the tariff noise has definitely been loud, and some of the reactions have been muted because they just don't know. And when you don't know, you kind of pause for a while, and that's what the economy has done.
And when do you think we're going to know what AI's impact on unemployment is going to look like?
It's a really great question. I think it's really hard to know because it's going to happen gradually, and it's going to just pervade our existence, and you're going to see these efficient parts of businesses that will continue to be grasping onto this AI narrative. And the easy stuff has already happened. It's already happening real time. Yeah. And I think you're going to see that a profound shift in the economy. You're going to see a shift from China to India. You're going to see a profound shift for a lot of things that are going to really change the way people invest and change the way people do work.
John, let me ask you the same question. When do you think that we will know what the unemployment rate post-AI is going to look like?
Well, I guess I expect this to be more of a structural change as opposed to sort of a one-off step function. So my baseline going forward is that you will see, again, more jobs moved outside of sort of, I think about the tech companies that have, exploded in hiring after the pandemic. Low interest rates, easy money, hire people, it's almost free. All of a sudden, interest rate environment changes. You start seeing really more calculated thoughts around sort of where people are working, greater focus on efficiency. Going forward, again, I think you're going to see even greater focus on efficiency, particularly for some of those white-collar jobs that are relatively mundane. But my expectation is that we actually have a pretty long runway until we see sort of the direct impact of AI on hiring. Again, I think we're in the early stages right now. We're still ramping up AI investment. And so then when you think about investment to implementation and then also, to execution, I see that as a 2-year plus sort of process.
John, really appreciate you joining us. Thank you so much for making the time.
My pleasure.
I also want to thank my guest host for the hour, Mark Lehman of Citizens. Really appreciate you joining us, giving us the tech insights, but also the M&A insights. It was great to have you for the hour. Thank you so much. We'll keep talking. Coming up here, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith will have you for the hour.